Good Monday, everyone. I hope you had a nice weekend. We finally got a little bit of sun in New England, not a lot. And the wind still blew hard, but at least it wasn't 50 and gray and windy. So let us start. Thank you for watching number one, first and foremost. If you like what you see, please give it a thumbs up on YouTube. Where are we going to start? So I was going to write a rather long piece on the blog over the weekend, and then the more I organized it, the longer it got, and I figured I would do a video so I could be interactive and show some charts a little easier. So that's the plan for today. We're just going to talk about some things that I'm looking at. I am recently back from the road, where if you know me, you know there's always something goes wrong on the road. And I've learned to laugh about it. On my flight down to Florida, one of my teeth fell out when I was eating a mango, fell into the mango bag. And that was one. And then my flight, true story, one of the light bulbs went out and they didn't have an extra at the New Haven airport. So they literally were going to send someone to the store to buy one, although nobody had one. So we actually sat and waited for another plane to land so we could go on their plane. And then on the way home, I hurt my back, lifting my bags into the car. So that was fun. And to add insult to injury, JetBlue, 3 strikes and they're out. They lost my luggage on the way home. That's the 3rd time this year with JetBlue I've had a mishap. So as you know, when you travel, you have to be relaxed and laid back. You can't go crazy because it's happening all the time. So suffice to say, it was really good to be home. So let's turn, I'm going to share my screen and we're going to talk about the topic from last time, which was, is this 1994 and 2018? A lot of folks have emailed and commented that this is not 1994 and 2018, it's 2008. Okay, and so I don't agree, but I want to give the due and show those charts. So let me share my screen. Good. So the first thing we're going to do is let's just take a look at, I'm going to make sure we can see the last year plus in our chart. And you can see what we've been living, that markets peaked in late December, early January, and we've had rallies and declines, and now markets are right back towards the lows we saw February 24th. So I want to share 2008. Okay. So let's see. So the comments that I got were essentially that, let's remove that, that's clear. So the comments I got were that this period in here, where the blue line is where we were to the end of February, and we rallied, and now markets are rolling over and they're about to go into a complete and utter tailspin, as you can see what happened in 08. So that's what people who are using 2008 as their analog think we're, kind of right here, and we are going to roll over and collapse. Look, anything's possible. I will say this with, pounding on the table. This is not 2008. Very few things or almost nothing lines up. The banks right now are overcapitalized. The banks have too much capital. It's hard, but not impossible to have a collapse in the economy and the markets without the banks being in jeopardy. Banks sitting on a ton of money. They're just not putting it out in the street. Do we have places like Fannie Mae and Freddie Mac on the verge of insolvency? Clearly we do not. And we don't have other institutions on the verge of insolvency either. We have a general malaise in the markets. I've spoken about it. I talked about what I thought would happen in Q1 early in the year. What I didn't get right was the magnitude of the decline, but I certainly thought there was enough pieces in place to have a Q1 decline. Part of the problem during that decline was that we borrowed. So in the end of March, we had this huge rally. I wanted it to stay down, and that would have given us a little more length to have a Q2 rally. Well, markets don't always do what I want them to do. So instead, we've had this decline since the end of March, and we are in jeopardy in the S&P of breaking to a new low. No, I don't see this as that period in May of 2008 where things just unravel and go down 58%. I don't see it. Too many things that are going on which look nothing like '08 or any other collapses. But I'll say this, price is the final arbiter. Price always wins. So no matter what indicators or data you look at, in the end, markets obviously can't rally without price, as stupid as that sounds. So where are we now? In all likelihood, we're missing one piece to the puzzle that puts in a bottom. You're missing that piece where there's that final whoosh and everyone sells everything for that 1 or 2 day period in what would be likely viewed as a selling stampede. Haven't had that yet. Is it essential? No, but most of the time you do see that. So that's what I'm on the lookout for now. If that happens, or if somehow markets stabilize and catch themselves. Let's go back to 2018 and 1994. So here's 2018. You can certainly make the argument. Here we go. So this was holding really well for until a month ago, and now we're kind of back down here where the 2018 analog had the market rallying into September. I don't think that we are going to have a rally to new highs and then another decline. That there's not enough time because it's already May 2nd. Come on, there we go. And so it could be with 2018 that we're somewhere in here. And we're on the precipice of that just final whoosh lower. That I thought would happen later in the year, and it still may, but that is one possibility. And then let's go back to 1994. I gotta find a way to do this quicker. And 94, I felt pretty confident that we were somewhere in this period, and frankly, we still may be. I still like the 1994 analog better. That maybe we're just we make one little marginal low coming up, and the 1994 analog still holds. So that's what I'm thinking market-wise. I'm going to stop sharing my screen. You guys, unfortunately, have to look at me again, but I do want to pull up a couple of charts that I thought were relevant. Let's see. Okay. So let me share those charts. All righty, a couple things I wanted to share, which says to me that this is not 2008. You're closer to a bottom than anything else. So here are the put call ratios. People who trade options are usually wrong when doing something in mass. You'll see that last week, the put call ratio, in other words, the amount of contract people playing for the market or stock to go down versus up, it was 0.85. I just showed, I'm not going to go into and get wonky, but just see that at the COVID low, it was much higher, and the 2018 low was much higher, but it's not that far away. It's not like in 2008, it was very low in that May period when things unravel. A lot of people are bared up and positioning for a lower market. Let me also, let's go to the new lows. I like that one a lot. So usually at the end of a correction, a decent sized decline, the number of stocks that make new lows over the last year spikes. Not all the time. There's nothing that we look at that's in always, must, need. It's just the usual, or almost all the time. So you can see in 2018, there were more than 1,200 new lows. And the COVID low, because we just throw everything to the wolves, the COVID low, there was like 2,400 stocks making new lows. And right now in this decline, we've got about 800. My sense is that if there is that one final whoosh lower, you'll get that number spiking well over 1,000, somewhere between 1 and 2,000. That would create the throwing the baby out with the bathwater. Doesn't so. Someone may ask, what happens if we don't get it? Well, what could happen is the markets could gather themselves and then rally and then have that final whoosh lower later in the year. It's not out of the question. And let me also take you to the last two things, which will be some sentiment. So here is the American Association of Individual Investors, a poll that's taken, oh boy, I think it's weekly, but it may be biweekly. So you'll see 60% of their respondents were deemed as bearish. We didn't have that number at the COVID low. We didn't have that number in 2018. That's the highest number, I think, since 08. And frankly, it may be higher than 08. Now we're asking me to adjust this, and I'm not going to do it right now. But I will look and report back. So that new lows are really, the number of bears is really spiking. And if you want to see what the bulls are, there's, I put my glass on for that. There's 16.5% bulls. That's by far the lowest reading since the great financial collapse. So you've got an unbelievable number of bears, almost no bulls. Let's look at the summary, and you can see the same thing in a different colorful way. So you've got folks that are pretty bearish. That's what you normally see. It's not that single point in time that says, okay, markets have to rally right now, but there are building blocks that put together a market bottom. And finally, the Fed meets on Wednesday, Tuesday and Wednesday, tomorrow, Wednesday. They're going to raise rates 0.5%. That's like 99.99%. Sure, you would need, frankly, God forbid, something really, some kind of global meltdown, perhaps in a war situation to prevent the Fed from doing it. Fed's going to raise rates 0.5 point. And I want to show you, this is nothing new. And I didn't invent it, and I don't want the credit. This is from my friend Tom McClellan, who does some awesome and very kind of unusual outside the box work. And what I've always said is that the Fed follows the markets don't follow the Fed. So you can see the black line is the Fed funds rate, the only rate the Fed controls. It's the overnight lending rate to banks. And the other line, the white and red, is the 2-year Treasury note. The Fed has a habit of, not always, but most of the time, following the 2-year Treasury note. So right now you'll see the Fed funds rate is roughly 0.25%. In 2 days, it's going to be 0.75%. The 2-year note is roughly 2.75%. So you can see the market is forecasting much higher, very, very short-term rates. However, before you hop on this soapbox that, well, the Fed's going to raise rates to 3%, what normally happens at the end of the rate hike cycle is the 2-year note rolls over or curls over to the downside as the Fed funds rate's coming up, and they meet somewhere in the middle. So no, I don't think the Fed funds rate's going to 3%. I think the Fed's going to blink, the 2-year note's going to come lower, and Fed funds rate's going to go higher, and they'll meet somewhere in the middle. I'm just going to make this up and say 2%. It could be 2.25, 2.5. It could be 1.75, but that's what I think happens. So the Fed's going to raise rates. If markets are still skittish, my sense is that they probably rally on the news. If markets are somehow soaring into the Fed news, my sense is that they reverse and pull back into that. I don't think there will be no surprises, frankly. So that is that. Let me stop sharing. Now you're stuck with me again. So that's my kind of short-term overview of where the stock market's headed, what the Fed's going to do. And let me close with this. And I can probably share another chart. Yeah, why not? I've heard some people pontificating that the reason the markets are selling off is because nuclear war, the likelihood of Russia using a tactical nuke is rising. And it's certainly from an intuitive standpoint, that makes sense. Okay, we know how Putin is, or maybe we don't know how Putin is. That's the problem. But in any case, people say, okay, well, there's a chance of some kind of nuclear dirty bomb, whatever you want to call it. And if that was the case, you would see treasury bonds yields going down. That is the ultimate safe haven. If there, God forbid, some kind of nuclear strike, people are going to run to cash and treasuries. So you're seeing the treasury bond market yields go up, meaning prices go down. That's not what you would see if people were truly positioning for some kind of tactical nuke. You'd see the opposite. Stock would still go down, but you'd see bond yields, long-term bond yields going down as well, and you don't see that right now. What you are seeing, frankly, is what I've discussed, and that is the market perceives the Fed to be breaking the back of inflation. And I've already said, I think the March inflation report released 2 or 3 weeks ago, I firmly believe that was the peak. I think inflation is going to roll over from there and eventually trend down to 4%, perhaps even in the 3s in 2023. But I don't think that the market is pricing in some kind of nuclear event right now, because again, you'd see people run to treasury bonds. All right, so that is, I'm always happy to answer your questions. You can call me, you can email me, you can make an appointment, come in the office, whatever you like. I'm always willing to oblige. If you like what you saw in the video, please give it a thumbs up on YouTube. And for now, that's it. I'm going to post this in a few places and then be back to you on the blog probably tomorrow or Wednesday with some Fed comments. Again, thank you so much for watching. I do appreciate it. Have a great day. Enjoy spring. Stay safe.